Everyone. Welcome to this morning's Canadian Lenders Association webinar on point of sale finance and the future of point of sale finance. My name is Simon Fitzpatrick, and I'm a partner in the business law group at the law firm of McCarthy Tétrault in Toronto. And I have the pleasure of moderating this morning's webinar and navigating the panel through the next hour. With that, I'd like to introduce the webinar panelists. In my bottom right on my screen, I have Denise Heffron. Denise is the managing director, at Uplift Inc. Denise has spent her entire career in the travel industry, having spent 25 years at Transat, where she was vice president national sales and commercial, and that included responsibilities with respect to B2B customer experience. She's also been a freelance travel writer, and in 2018 joined Uplift in Canada. Uplift is a travel fintech company that allows customers to pay for their travel over time with the goal of making travel more accessible and affordable. Uplift works through an impressive network of travel partners, from airlines to travel companies, to enable such travel brands to offer consumers flexible payment options and creating new opportunities for their travel partners. Welcome, Denise.
Thank you.
In my bottom left is Wayne Pauman. Wayne is the president and CEO of PayBright, a Canadian fintech payments and lending platform. After attending both Harvard and Cambridge, an impressive combination, Wayne started his career in consulting with Bain and Company before moving to the world of private equity at TorQuest Partners. Wayne joined PayBright in December of 2015 and has overseen a tremendous period of growth and innovation during his almost 5 years at the company. PayBright uses technology to provide consumers with point of sale options in both e-commerce and in-store environments, and has partnered with now over 6,000 domestic and international merchants, including leading retailers and brands such as Wayfair, Samsung, and Casper. PayBright provides installment payment plans that allow consumers buy now and pay later, while also driving and creating value for its merchant partners. PayBright has provided over 2 billion Canadian in loans since its inception. Welcome, Wayne. And finally, David Fry. David is the CEO and founder of Pays Financial Technologies. Prior to joining the fintech ecosystem, David enjoyed a successful career in finance and capital markets. After graduating from McGill, David joined the TD Securities, working in various capacities in Toronto, London, and New York, before moving to ABN AMRO in London, and finally back to Toronto at Deutsche Bank, where he served as head of Global Markets Canada. David then combined his entrepreneurial spirit with his passion for technology and his knowledge of finance to enter the world of fintech by co-founding Aspire Financial Technologies, an alternative lenders marketplace. In January 2018, David founded Pays with a simple mission of providing Canadians more affordability and access to travel. Pays has partnered with merchants in the travel industry and provides consumers with installment payment plans. Welcome, David.
Thank you.
During today's webinar, we're going to explore point of sale finance, the key drivers of its growth, its ability to disrupt consumer financing, and its future. The concept of point of sale is not a new one. In fact, its origins probably date back to the inception of physical retail. However, with the explosion in innovation and technology, the buy now, pay later point of sale finance model has become much more than a payment model. Technology that enables the consumer to receive instant credit, whether in a physical store setting or online, is changing the way Canadians purchase. Point of sale initially targeted lower prime assets, larger ticket items, but has rapidly evolved into is now capturing increased market share of the smaller ticket, higher prime segment. As consumer and merchant awareness and preferences shift, point of sale finance is outpacing the growth of more traditional consumer and unsecured lending. Recent research shows the size of the point of sale finance market in the US is approximately 390 billion, or about 3.5% of annual consumer spending. And a 2018 report by McKinsey estimated that outstanding POS installment balances were expected to account for 10% of all unsecured lending, in the United States. And with that background, it's time to turn over to the experts. Just one housekeeping matter. We're not following a script. We have a few talking points, so we're hoping to have some great discussion. We're going to save all questions and answers for the end, so we'll probably around 11:15 or so open up the Q&A, and you can do that by posting your questions online. So with that, I'm going to turn over the microphone, if you will, to Denise Heffron. I'm going to ask you, in terms of your business, what is driving point of sale finance for you in Canada?
Thank you, Simon. Thanks for having me today. I'll start a little bit with the history of Uplift and how we got to this place in Canada dealing with a number of travel partners. Our company was conceived in and around 2014. We're based in the Silicon Valley in California. And we really set out to build a product that spoke specifically to the travel industry. So, certainly I have a travel background and our front end people have a travel background, but really within the organization, there's deep, deep travel knowledge, and we've built our technology to address that. What we do for both consumers and our partners, as you mentioned, for consumers, our mission is to make travel more accessible, affordable, and rewarding for clients. And that's sort of how we position ourselves with consumers. But also, I think we bring great value to our travel partners in that we provide a seamless integration. And at the core of that is we drive value for them. I think through our product, we aimed to integrate deeply with our partners from the top of the funnel right to the payment page. So, there's lots of ways to finance things. There's lots of payment options out there. But I think what is truly unique about Uplift is that our product, not only our lending product and how we adjudicate our loans and things like that, speak to travel-specific purchases, but the way we have built our product, continue to develop our product and integrate with our partners is truly travel-specific. And it is, it's our belief that travel is different, it is special. Someone that is financing a mattress or a bike, we don't believe it is the same purchase journey that it is for travel. And we think for the customers, it's very important to provide means for them to have an alternate choice, to do this quickly, seamlessly. There's no human intervention. We use, machine learning and algorithms to both adjudicate our loans, but also curate our loans to ensure we're giving the right loan to the right person for the right product. So that's sort of Uplift in a nutshell. Our core product is a B2C integration for people, for travel companies, and it's any kind of travel company as well. We work with cruise lines, airlines, tour operators, travel retailers to bring their product via their website to their end consumer. We also have a very interesting B2B2C product where we're integrating with travel distributors that are distributing to a number of secondary companies in the industry that in turn can offer this product to their clients. And lastly, we have what we call our standalone tool, which was really designed to support travel advisors because we know in the travel industry in both the US and Canada, they're a very important part of this ecosystem. There's a lot of issues around parity with travel retailers in the country here because many of the organizations we deal with are vertically integrated and they actually own retail. So we've created, 3 products, I think, to speak to all of those segments of the business. But again, our core product is our B2C integration for travel provider websites.
Great, thank you. Wayne, same question to you. I know we've had prior discussions on whether point of sale companies are more than just lending companies. So perhaps when you give your feedback, you can speak to that as well.
Sure. Yeah, I think I start by putting this in a bit of historical context and maybe touching on some of the themes you raised in your opening piece there, Simon. Like this business model in principle has been around for a whole decades and decades, right? And the model sort of settled on a certain type of model at some point in the past, and I would say kind of got stuck there for a while, which was a credit card based model. And I think most people would be very familiar with, you're going into a big box store, buying furniture, electronics. You see an offer for financing to not pay a cent for some period of time or pay over time with no interest. You express interest in that. You fill out some sort of application, which historically would have been a fairly lengthy paper application that the store staff would take time walking you through. More recently, that form sort of went onto a tablet, which was a technological tweak in that model. But that's how point of sale financing in the retail space anyways was dominated for many years. I think what's really changed in the past 10, but really the last 5 years or so, is the ascendancy of simple installment financing as an alternative to a credit card based product, where it doesn't involve signing up for a store card. It doesn't involve getting a card in the mail. It doesn't involve receiving monthly statements. It doesn't involve a lengthy application form with, all kinds of details about your income and assets and, mother's maiden name and everything else. It's a very simple, clean, easy to understand installment product that is meant to be almost as easy to use as, tapping or using your existing credit card, like a Visa or MasterCard. And that's really been a game changer. And I think what's brought that model of retail financing to the fore has been the digital shift. So the rise of e-commerce, where retailers, for the most part, won't tolerate a long, difficult, lengthy process as e-commerce checkout. It has to be quick, fast, and easy, and in keeping with what the retailers have spent millions and billions of dollars on their website to make it fast and easy. The payment methods have to be that way too. They have to be simple, fast, transparent, consumer-driven, easy to use, automated, no human intervention. That has really taken off in e-commerce, especially in other countries, which we're now seeing in Canada. And it's now going in store as well, where a lot of retailers are saying, hey, I'm not sure I need a store card. Some retailers still want the store card, but this installment model, which is what Uplift and Pays and PayBright all specialize in, is sort of taking share to some extent away from cards. And in addition, it's bringing installments to a bunch of retailers that never would have had financing before. So that's a fundamental change that's gone on in the industry. It's easy to use for the merchant, the consumer. It drives a very high share of checkout spend, and it drives a lot of repeat usage, which wasn't the case with the older models. So those are some thoughts on how what's happening in the industry now is quite a bit different than what we would have seen maybe 10, 20 years ago.
Great. David, curious as to your views on installment payments versus credit cards, both credit cards as well as I don't know, sort of bank issued credit cards as well as private label credit cards. And I guess the issue of having your credit adjudication up front. I guess a lot of installment purchases are based on each individual purchase. So I guess there's a new credit adjudication for each purchase, whereas a credit card, you're approved up front, and then presumably you don't go through an adjudication each time you make a purchase. Can you talk about that a little bit?
Yeah, look, I think I agree with Wayne's assessment of kind of what's led to the growth of installment financing led point of sale financing, if you will. That I think for a lot of use cases and for a lot of consumers, it's just a better product. I think, I don't get sort of religious in terms of whether it's a card or an installment loan, though. I think it's really kind of like, what is the customer looking for? And then what do they have to pay to get access to that product. I think if you look at the growth of, I guess what we'll call buy now, pay later, which some might say is a subset of point of sale lending, and some say it is point of sale lending, but let's just say that it's the digitized version of point of sale lending. I think a lot of that is being pre-COVID is being driven by a new generation of shoppers who have, you know, a very high threshold of user experience that is coming from these big tech digital apps, and then that creates expectation then for delivery of everything else that they're doing, including financial services, to have, you know, that same level of user experience, right? And that gets into efficiency, speed, efficacy, communication, et cetera. And so I think, you know, and I think that generation too has largely shown an aversion to revolving credit. And there's lots of studies around why that is, but one of them is they kind of saw their parents in 2008 and 2009 dealing with heavy loads of revolving debt and what to do with that. And so that generation then has grown up using debit cards, and to the extent largely that they've entered the credit space, they've done so through installment loans, which have transparency, they have payment certainty, and typically they have interest rates that are much lower than can be seen on cards, right? So that's been, that's really driven pre-COVID a lot of that growth. And then as we've seen the last 4 months during this period, the shift of physical to e-commerce, a lot of merchants having to play catch up really fast, banks potentially caught wrong-footed by their lack of preparedness from a digital offering perspective, still have this 50-year-old piece of plastic that we're, you know, trying to put in people's hands. And so, you know, I think that that's driven then, the shift to e-commerce is then driven and accelerated even further the move towards buy now, pay later solutions, in particular from millennials and Gen Z, but even more generally across a wider range of demographics.
Right, that's interesting. You just raised the issue of banks in their short-sightedness around their digital offerings, which I guess have been enhanced during this pandemic. And we've seen this play out certainly in the small business lending space, where there's been perceived competition between the banks and other consumer lenders and the alternative fintech lenders. What is the relationship with banks? I know this is not a question that we spent any real time going through, but it's an interesting point, and I thought I would just follow up on that. David, maybe I'll give you first shot on that, and then I'll go to Wayne and Denise.
Yeah. So look, let's say for the audience here that the three companies that are presenting here, this is a tough ask for us, right? Like, we're actually going up against some of the biggest incumbencies on the planet, right? Like in any industry, and certainly the biggest within financial services, those being banks and credit card companies, right? So we're basically going out and saying that, you know, that's an inferior product, it's an inferior process, and we have a better way of doing things. And so, you know, I think that, you know, and what do those companies have besides, you know, I mean, I looked at Visa's Q2 earnings this morning, and they're down marginally, but heck, they're still making billions of dollars, right? You know, so they've got lots of customers, they've got incumbency. You know, our advantage is that as startups is that we can really move much quicker, and we can grow and change the product base as user preference changes as well. And obviously the last 4 months, user preference has changed dramatically, right? And so, you know, as I've said a few times in the last few months, is that this space, buy now, pay later, digital point of sale lending, whatever you want to call it, has never been better positioned. then right now, this is the moment in time then to really show consumers a different way, potentially a better way. I by the way, so I didn't use the word short-sighted, you did, in terms of banks. I think I used the word wrong-footed. And I think that, sometimes you need a 100-year global pandemic as a catalyst to make change where there's a lot of inertia to make those changes. I would say that the banks may be slow, but they're not stupid. They are seeing mass amounts of their most valuable customers, millennials, migrating to these types of payment platforms. And so, when we saw a few weeks ago, Visa introducing, obviously they've been working on it for a while, the installment feature, the APIs that they're trying to provide at merchant checkout for card issuers. It's certainly in response to that. So, I don't think this is an arms race, so to speak. I think, ultimately the consumer is the winner, which, to say that in Canada is a bit of a revelation in financial services, that the consumer may actually be a winner here, because we're going to see increased competition. We're going to see better product that's better suited to that purchase. And I think ultimately we're going to see interest rates that are more favorable for the customer as well.
Right. Wayne?
Yeah, no, I think I would agree with a lot of that. I think, so obviously the banks are major players in the traditional credit card business through their Visa, MasterCard partnerships. Most of the Canadian banks have gotten out of sort of traditional point of sale lending for one reason or another. But to David's point, what's happening now is banks in Canada and other countries around the world are trying to make sense of the rapid growth of buy now, pay later, and assess to what extent it's a threat to their existing card business, and are trying to figure out what the response is. Is it buy platforms, build internal platforms, do it through a Visa partnership? There's a lot of churning going on right now within a bunch of different banks trying to say, okay, buy now, pay later has gone from a little niche thing to something that's carving out billions of dollars annually, still small, but seems to be growing. And in the markets like, let's say, Australia, which are farther down the track on this, credit cards are actually in precipitous decline, and millennials and to the front end of Gen Z are using buy now, pay later as a credit card alternative, never signed up for a credit card in the first place, and are using, for one company that's leading in Australia, a buy now, pay later company, on average, customers are using that for 25 purchases a year. So this is not your old, once every 3 years I'll buy a couch point of sale lending. This is a different thing altogether. So banks are looking at this and trying to figure out what to do. And my prediction is in the next couple of years, we'll see some US banks moving on this and making some bold moves in this space. And then I think we'll probably see something happening in Canada too, but typically we're a year or two behind in this evolution.
Right.
Hey, Simon, can I just add something to that quickly before, I know Denise wants to answer too, but when you see Shopify partnering with the firm in the US, that's the moment to start paying attention now. If you're sort of sitting and running a bank credit card division, if you weren't paying attention before to buy now, pay later as a threat to cards, you for sure are now after that announcement this week.
Right. No, that's a good point. I saw that. And Denise?
Yeah, I agree with everything that David and Wayne said. I see the installment payments. David spoke a lot about the digital aspect of what we're doing and the speed and the ease of purchase and things like that. But it goes even beyond that. It's about buying behavior. I think we've moved into a world with millennials and Gen X in particular, where paying monthly for things is a really normal way of living. Spotify is monthly and Netflix is monthly, and it's an interesting way to manage your money and your business. Hence the rapid growth in both the US and Canada. Certainly, I agree. I think banks would be looking at this very closely at this point. Can we coexist? Of course. I definitely see what we're doing as a fundamentally different product, though. And it's not for us to tell consumers how to buy. We sit alongside on our web integrations. We sit alongside pay in full today, pay with a credit card, pay with a deposit, or pay monthly. It's not my job to tell someone how to buy. I think it's our job to be present as an option, though, for sure. Could coexist turn into strategic alignments down the road? Possibly, I'm sure, but for the moment, like I said, we see this as fundamentally different, and there could be some cannibalization, but it potentially could be an entirely different customer. If we're able to drive higher approval rates, for example, or lend to people that have yet to establish credit, for example, because of the various data points that we look at that goes far beyond just a FICO score, that could be a net new customer as well. We're not necessarily wrestling all these customers away from credit cards. So.
Right. Okay. Well, thank you. That's very insightful. One of the themes that has surfaced on these discussions is that the consumer is the winner here. But one of the things I find also beneficial about point of sale finance, if done correctly, is that merchants also win. So it's a win-win scenario. And Wayne, maybe I'll ask you to just give us some feedback as to how you're creating value for your merchant partners. It's not just PayBright making loans to consumers, but you're driving creation and revenue for your merchant partners.
Yeah, for sure. And I think there's a couple pieces to that. I think the first one is that when retailers partner with companies like ours, they typically see very good results in terms of the performance of their website or their stores. And so the main, easiest to spot benefits are conversion rates go up. So out of every 100 people that visit a store or a website, a larger number will decide to complete their purchase on that day, and you reduce things like cart abandonment, which is a constant battle for e-commerce retailers in particular. You tend to see increased customer traffic, so new and repeat customers, which I'll come back to in a sec. And then average order value tends to go up as well. So the customer understands that they have an increased budget to work with, they can spread payments over time, they're not going to get stung with revolving or deferred interest, and they become more comfortable in perhaps buying a higher level of a product or buying two products on that day. So through that sort of affordability and spending power benefit, that helps retailers too. And typically these are very measurable, especially in e-commerce. We've had situations where we've gone live with a merchant on a Tuesday, and by Wednesday they're saying, "Oh my God, AOV is up X% and conversion is up, and this is amazing." And the sort of proof of the pudding is that if a retailer is used to spending, say, 1.8% for a credit card, they'll pay significantly more than that to an installment provider to offer an interest-free product, because even with that additional cost, the gross margin or gross profit benefit of using installments is there because of the gains in conversion and average order value. And if you've ever looked at the math that a retailer does on their e-commerce site from the very top of the funnel all the way to the bottom, and the power of each of the little drivers that produce gross profit at the bottom, some very small tweaks in some of those drivers really produces a huge benefit on the bottom line. And that's what the sophisticated retailers are doing with installments. So that's thing one, and I think everybody kind of gets that now, and that's what's driving a lot of the demand for the product. Thing two, which we are down the path of, is initially when you're building these businesses, you're signing up lots and lots of merchants. Through the merchants, you then start to acquire a large consumer base. Every day, hundreds or thousands of people come onto our platform through our retailer partners. And so you end up with this large and growing consumer base. And then the question is, how do you engage that consumer base and help them understand the value of the PayBright platform or the Pays platform or the Uplift platform? And you've given them a good user experience. They like the product. They didn't get a nasty surprise in the mail with their financing product. And you can start to engage that consumer base, whether it's through a portal, through your app, and drive customers back to retailers and serve up to those customers offers that would appeal to them based on the data that you have about their interests and their buying behavior and their demographics. And then that becomes another huge benefit for the retailers, which is that you're a source of traffic for them. You're a source of demand. And this has really changed. So 3 years ago, retailers would never say, how many customers are you going to send me? How big is your user base? Now that's like question one. Because as BNPL has grown, Buy Now, Pay Later has grown, the providers' user bases have grown and they've become a source of traffic in their own right. So that's a really important theme in the industry right now.
Great. That's very, very interesting. David, over to you.
Yeah,
similar.
That's acquisition and conversion, right? And so that's the model we started with a very consumer centric. We sort of always went with the view that the merchant would win if we could get the customer, right? So that if the customer had a great experience, they'd make a purchase, they'd make a higher value purchase, they'd make more purchases than they would otherwise. So let's understand that customer and what they're trying to do. And you know, as Denise rightly pointed out earlier, that in the travel space, that purchase journey is quite a particular purchase journey. It's different than buying a mattress or a couch or, you know, a Bose sound speaker or something. Most of those happen out of necessity, or they happen, you know, very quickly. Whereas travel, you know, has a really passionate, inspiration-based approach, really, and then it moves into research, and there's all sorts of things going on there, and ultimately to booking or purchase. So yeah, so we've sort of taken the view that we can help our merchant partners really by, one, providing an experience for a customer that gets them to do more of what the merchant wants, and that helps them then with acquisition. So we're actively acquiring customers into a marketplace, and thereafter with conversion. And so these are incremental people that would not otherwise be on the merchant site, who are now all of a sudden actually purchasing from them.
Great. And Denise, I know when we spoke previously, one of the things that you had mentioned was the ability of point of sale lenders to innovate and be creative in terms of coming up with new offer types, whether it be 0% interest. Did you want to speak a little bit about that and what Uplift is doing?
Yeah, and just one thing I'd like to add to Wayne and David's comments on the purchase experience. I think another really key thing that we do is it's not just the purchase that we're revolutionizing, it's the entire shopping experience for a client. And when they're going through a flow, I think it's very interesting and brings a lot of value to our partners when we can say, you know, would you like to upgrade for $5 a month? Would you like to add a seat for $2 a month? Would you like to pre-order your meals for $1 a month? And we can serve that up through the entire booking funnel. So of course we have lots of tricks and tools to help build cart size. And I think that notion of when the customer understands that it is only a couple of dollars a month, you know, I can fly in business class for what it costs me to buy a Starbucks once a month, or that kind of, you know, psychological understanding of the cost. And I think it really, so, you know, it's for sure acquiring customers, driving conversion, building revenue through the entire shopping process is really key. We also bring value in terms of things like fraud mitigation for our partners, for example. You know, in our model, we assume all the risk for delinquencies or fraud and so on. So that's huge value to the supplier. We pay our partners in full at time of booking. That's a huge value to the supplier. So there's a lot of benefits for both the customer and the supplier. Having said all that, Simon, I forget what your question was. What did you ask?
When we had spoken previously, you would one of the things that you had highlighted was just sort of the ability to create sort of new offers and more innovative and creative ideas for the purchaser.
Yeah, absolutely. I think, any company dealing in fintech innovation is king for sure. It's something that we spend an enormous amount of time on. But I think it's that notion of being able to use installment payments or financing as a tool to, I can't remember exactly how David worded it, but to educate a consumer or encourage a consumer to behave in the way that our partners want them to behave. So, for example, in the airline industry or the travel industry, you could strategically use 0% financing to drive a particular route that you're suffering on, for example. So, financing out across the board, but we're going to do a 0% subvented offer for Toronto, Cancun for the next 4 weeks. And drive business to Toronto, Cancun for our partner. So
I'm in, Denise. I'm in. Let me know when that's starting. I'm in.
I have a voucher like everyone else in Canada. I can't wait to go on a trip. It's true. Yeah, so I think there's lots of things we can do, and different partners, just like different consumers have different wants and needs. I think some of our partners have different wants and needs, and depending on who our partner is, longer term loans might be interesting. Other partners, that maybe have a lower ticket price, an ultra low cost airline, for example, might want shorter term loans. So we can play with all of that, and we can sort of customize offers for our clients for what suits them best. And of course, we also, working in conjunction with our clients, we understand the consumer. We have information on the consumer that can help us work together to retarget or go out with an offer and things like that. So there's a lot of creative things that can be done, and I think that's what is really the secret sauce of what we all do. That's the beauty of this product.
Right. Just looking at the time, we have 20 minutes left, and we've got some questions coming in. But I did, as a final sort of formal question, sort of ask each of you how you see your business model shifting in the future. Wayne, you mentioned the Australian company that has taken sort of point of sale to a completely different space. How do you and where do you see PayBright going in the next few years? And then I'll go over to David, and then finally to Denise. Excuse me.
Sure. So I think the buy now, pay later model that we're talking about here, which is highly integrated, easy to use installments. I think we're in the early innings of this in Canada. And frankly, globally, but Canada's probably 1 to 2 years behind some other markets. I think we're going to see really rapid growth in this space. The amount of retailer interest we now have compared to a year and a half or 2 years ago is quite astonishing. With some of our products, particularly our small ticket product that we call Pay in 4, when we talked to retailers about it in 2018, they just literally didn't understand what we're talking about, and now they all want it yesterday. So there's a huge shift happening there, and so I think we feel like we're pretty well positioned to participate in that trend in Canada. And like I said, there may be other entrants or other market participants who sort of get in and grow that market as well. So I think that's one thing. The other thing is the speed of change and innovation is quite relentless in this business, because it's now more payments than lending in a way, right? So lending has not had, let's say, the same intensity or speed of innovation as the payment system has, which is like incredibly sort of dynamic and ever changing, and we are feeling that more and more now. And the things that we get asked for by merchant partners, especially large US-based or international-based merchant partners, in terms of what best practices they're seeing around the world is sort of changing by the month. And so we're running as quick as we can to fulfill those needs and deliver that before anyone else in the Canadian market. So those are some general comments. And then I think for us, which I've already touched on, our consumer strategy, initially you have a merchant strategy and it shifts to a consumer strategy. That's a big piece for us as well. And figuring out how to keep delivering value and ever increasing value to not only the merchant and the consumer, and driving that ecosystem and that engagement, in all directions.
Great. David?
Yeah, so we're a believer in the marketplace model, because that's how we've sort of built our business model, and I think that marketplaces are going to continue to take share in the sense of aggregating consumer purchases and the embedded value add of buy now, pay later solutions. I think Shopify is the latest example of that. You've got big aggregator platforms out there like Amazon, Facebook, etc., all of whom already have some versions of e-commerce marketplaces. So I think the opportunity there is really to go after the card in terms of creating a better experience and a better product. Look, as it relates to us, look, I'd just be frank and say I'd like to survive this period in history as a company. We're much younger and smaller than my other two colleagues on the phone right now, or on the call. So yeah, and I think with every kind of challenge, opportunities are presented. I think that our focus on the consumer and what the consumer is trying to do, I think has given us a lot of insight and potential opportunity to evolve and potentially pivot as a company kind of going forward. But yeah, but I think that, as Wayne said, this is a really exciting time to be in this space.
Great. And Denise?
I agree. I see only rapid growth and innovation. How quickly we have been able to grow in Canada has been very interesting. And since COVID hit, of course, because we're deeply tied to travel industry and travel partners, it's been a difficult time for travel, clearly a very difficult time for travel. But the flip side of that is, David said earlier that there's really no better time to be here. And I agree with him. Our value to our partners has increased. What we've had experienced through this is partners coming back to us saying, let's do more, let's integrate more paths. Can we cook up a new loan product? We have new partners knocking on the door that, might have been, lukewarm at best before, that are very interested now. Let's move, let's go. Because I think they see us as a means, one tool in the very big toolbox of recovery. So for sure, in the travel segment, I see this only growing and growing. For me, it's same. It's hard to envision 5 years at the moment. I'm sort of working on short and midterm at the moment, getting to the other side of COVID, getting back into the market with all the great work we've been doing while this was going on. And we've been chugging along quite well through all of this, which is very interesting to me. It's been very interesting to me to watch, because it is certainly the biggest crisis the travel industry has ever faced. But what I would say clearly from both consumers and partners, there is definitely an appetite for this product, and there's an appetite to continue to grow and innovate in conjunction with us for sure. So it's all positive.
Great, fantastic. Okay, so at this juncture, I think it's just after 12, or sorry, I'm in the Maritime, so 11:15. I think we're going to go to the Q&A portion. We have 4 questions. And we're just going to lead off the top here. And so I guess unless someone wants to answer it, I will read this live. So the first question is, which industries do you see as the biggest opportunities for buy now, pay later, other than travel and consumer retail? Who wants to take a stab at that? David?
Okay, I'm gonna give an answer that I know Wayne and Denise won't give. I'm thinking small business. Small businesses, there's a huge focus on now in terms of economic recovery. They're all going to need a lot of help. They need to purchase things, and I think that installment payments that are going to monetize in some way the purchase value and give them discounts on interest rates would be a great innovation for companies to be doing.
Okay, well, Wayne, he kind of segued into your response, I think.
Yeah, so I think what's interesting is that as the installment payment experience has become easier, better, faster, slicker, more consumer friendly, it's allowed it to be, as we've already said, become a true alternative to credit cards for a meaningful chunk of the population. So it used to be the case for point of sale financing. You'd say, okay, well, which retailers have an average order value of $1,000, $2,000, $3,000? We're only going to talk to them. now that we have a product and other companies have a product that is truly a credit card alternative, it opens the world up massively. And so I think we're going to continue to see this spreading across all kinds of categories. We may not get to, for a while, to the point where it's like in Brazil where people pay for, restaurant meals and gas in installments. So we may not get there, but there's, vast swathes of retail sales in all categories, hundreds of billions of dollars of addressable sales in Canada that are potentially, in line to adopt installments over time. So that's one of the reasons why it's such an exciting industry right now. And again, we're seeing some of this already happening in other markets. Great.
Denise, do you have some views?
The same as Wayne, and in fact, I was going to use Brazil as an example, and he beat me to it. But any and all retail, I think installment payments could be interesting for. The loan product will differ dependent on what the consumer is buying and what the average ticket price is. Is it a short term? Is it a long term? Is it 0%? I think there's lots of flexibility in that. But really, I think this is a product. 2 years ago in Canada and a few years ago in the US, no travel companies were doing this. Almost every travel company is doing this now. And I see this as an interesting product for any retail segment. And I agree with David as well, small business as well. Why not?
Great. So next question. When do you think banks will start moving into this space, if at all? I mean, we did discuss earlier just about how banks are sort of in the space. David, what's your view on when we'll start seeing banks show up?
They already are. So Marcus, which is the digital bank of Goldman Sachs in the US, they recently formed a partnership with JetBlue, where they're offering installment payments on JetBlue travel purchases. Another example would be CIBC with their PaySit program. Wayne may say that that's a slightly inferior product than an installment product, I'm sure, but it's a card issuing bank that's kind of seeing the potential, if you will, for installments embedded into a credit card. And other than some of the kind of things that Wayne talked about, acquisition / partnership, I think, my view is that the banks, the card division of a bank is a very powerful silo. It has a lot of revenue, right? And it's not going away anytime soon. And I think that if banks, I think the immediate way that banks get more involved is by turning credit cards into installment payment options, as opposed to themselves introducing a new product that's just a pure installment loan.
Great. Wayne or Denise, did you want to give any thoughts, or should we move to the next question?
Yeah, I can just touch on that quickly. I think different. So David's 100% right. Banks in other countries are already doing this in one way or another. In Canada, the banks participate through players like us. Like we have our financing on a day-to-day basis comes from 3 different Canadian banks. But in terms of direct participation, I think over the next few years, we'll see banks pick their path. So some will get behind whatever, let's say, Visa's doing. Some will partner, some may buy, and some may not do anything at all. I think that's all going to be worked out in the next few years. What I think is unlikely is a bank trying to get directly into this business and build it from the ground up, because it's moving so fast and it's a very difficult to execute, both from a merchant service standpoint and a technological standpoint, that if you're not in this game right now, it's going to take you quite a while to get up to speed. So that's why I think, partnership with existing platforms or rails or acquisition is the most likely path for banks.
Great. I'm going to move on to the next question. Denise, I'll have you answer this one, if you would. And the question is, how are each of your businesses building and maintaining a network of customers, especially with encouraging consumers to repeat purchase using your service?
Honestly, that's probably a better question for Wayne, because our model is not one of a retail marketplace. We work only in conjunction with partners. So it's our positioning that, if I'm working with Air Canada or Sunwing or whoever that might be, It is Air Canada's client, it is Sunwing's client, and we will only retarget and remarket to those clients in conjunction with the partner. And we don't share data at all. So it's quite a bit different fundamentally than I think what someone like PayBright is doing, for example. So I'm going to lob that one to Wayne.
Sure, Wayne.
Sure. I think so. There's a few things. Number one, to encourage that consumer network, the consumer repeat behavior. Firstly, you have to deliver a great experience, right? If the customer has to say, "Wow, that was super easy. I understood it really well. It was easy to use. I was treated properly and fairly. This is a great product." Everything obviously starts there. Contrast that with, I filled out a lengthy application. I had to give, personal data. I missed my payment by a day, and then I paid hundreds of dollars of retroactive interest, which is how card-based products have worked for many years. This is a very different consumer experience we're trying to deliver. So everything starts with that. The second thing is you need to have a critical mass of high-quality retailers or travel providers or whatever it is that you work with, so that consumers are excited to use your product again, that they see as they travel on the internet or in their shopping lives. So you need to have the critical mass of places that you can be used as a payment method. And then I think the third thing I've already touched on is the engagement, right? So how do you continue to show the customer and give the customer a path back to that repeat purchase, whether it's through your portal, your app, post-purchase marketing and engagement, all of those tools that you use to facilitate the whole thing. So those are some of the elements that go into it.
Great. I'm going to go to the next question so we can try and get through all of these given our time. And David, I'll maybe get you to answer this one. How do interest payments compare to a credit card with interest at 19.99%? PA and merchants paying 2.5% transaction to the banks, Visa, MasterCard, et cetera. What is the fee to the merchant?
Okay, so this is the secret sauce to POS lending, right? So we all either are lenders ourselves or work with lenders or have a balance sheet that has a cost of capital attached to it. And we would score a customer using risk-based pricing across a spectrum from, let's say, 9.99% up to, say, 24.99%. And that excludes any merchant discount. Then we go to the merchant and say, hey, we can actually help you acquire or convert more customers, and we'd like you to pay us a fee so we can go and offer either discounted or fully discounted, in the case of 0% interest, to everybody. And so those fees work as follows. So if you're doing the short-term, low AOV tickets, where you're doing like a pay over 4 biweekly payments, the merchant will typically, in lieu of paying a credit card company, the interchange of 2.5 or 2.75%, will pay the provider, the BNPL provider, say 4 to 5% for that. You as the BNPL provider will be taking a debit card or credit card back from the customer. Obviously, if you're taking a credit card, then you can deduct those fees from what you're making. If you're doing bigger ticket stuff, typically that's 6 months and longer, 6, 12, 18, or 24 months. The math obviously suggests then that the cost of providing 0% or discounted financing on a present value basis goes up quite substantially as you move out in maturity of that. Therefore, you need to charge more to the merchant for that. Typically, Wayne, I guess might disagree, but probably between 5 and 10%, depending on the category and the term that you're offering. So the consumer, in the end, really, it's the consumer seeing 0% or something much lower than they'd see from a credit card, which is going to entice them to make that purchase, which then makes it worthwhile for that merchant to offer that discount to provide that financing.
I'm going to move to the next question, which is also credit card related. Question is, do you see the new Visa installment offering as a threat to fintech specializing in buy now, pay later? If not, why not? And what is the difference? Any takers for that one on the panel? Wayne?
I can take a shot at that. I think Visa has been trying to work on this for a couple of years to figure out what they're going to do from a buy now, pay later perspective. And, you know, the issuers have been wondering about it and retailers have been wondering about it. Like the key for this to work for Visa installments or any other provider is to move from being a simple payment method that's presented in checkout to move up the funnel and engage the consumer during the purchase journey. Like that's what's different about buy now, pay later versus one of the things that's different about buy now, pay later versus other payment methods. So that's what they need to figure out how to do. The one thing that Visa is going to have to grapple with is it has to work for everybody, not just people who have a Visa product, right? So if it's in any way limited to Visa credit or branded debit card holders, that's not going to be the solution for a merchant, because there are lots of people, especially young people, who don't have those products, and so, you know, the buy now, pay laters can appeal to pretty much everyone who's approved, because they can take payment in multiple different ways. So I think it's still early to say exactly what Visa's implementation is going to look like, but those are some of the things that we think about. But, you know, we certainly don't count them out. Visa's pretty good at a lot of stuff, but you know, they have to obviously change their existing model to make it compete directly with buy now, pay later.
Yeah, and as we were saying earlier, it's not just about paying. You know, it's what Wayne was saying there about the entire customer journey and what the customer is experiencing when they're purchasing. So, you know, there's the finance part of this, but there's the tech part of this, which is very critical.
Right. Okay, and we can answer one last question, given we've got, well, we're right on our time limit. I think this next question can be addressed by each of you. I think it's pretty easy to answer. Do you use blockchain technology currently? And if not, will you use it in the future? David.
Not currently. Happy to take a look at a use case that, a real world use case that blockchain solves a problem for.
I did the exact same. If it's at such time as someone in our industry who's you know, bigger and more sophisticated than us is using this for a real use case, we'll be all over it. In the meantime, we're not going to spend any precious resources trying to break new ground on that.
And ditto for us.
And Denise.
Same.
Ditto. Great. Excellent. Well, listen, with that, I'll bring this webinar to a conclusion. I want to thank each of the panelists, David, Wayne, and Denise, for contributing your insight and your time. We've done our best to, and intentionally stayed away from the pandemic, but I'd like to wish everyone continued health, and I hope that the pandemic will soon pass. And I look forward to hopefully doing this in person at a later date. I'd also like to just plug the CLA again and to Tal Schwartz for helping organize this. It's a great organization, and we're all happy to be part of it. So with that, we'll bring the webinar to a close. Thank you very much, everyone, and stay healthy.
Thank you.
Yeah, you too. Thanks so much.